Heidi Klippel is a San Diego native. She attended the University of San Diego, where she graduated magna cum laude with a bachelor's degree in political science. Knowing she wanted to be an attorney, Heidi began working in law offices at the tender age of 14. And she shared with me in a previous seminar, she wasn't preparing estate plans at that time. She was stocking the soda machine. But anyway, she still remained enamored of the law. And she graduated from USD and went on to obtain her Juris Doctorate from California Western School of Law, graduating in the top third of her class. During her time as a law student, Heidi concentrated her law studies in the areas of estate planning, tax planning, and corporate business law. She has been serving as an estate attorney for some 18 years now, since 2004. And she has been the RA's select professional partner for all of our legal presentations for over 15 years. Let's warmly welcome Heidi Klippel.
Well, thank you, Suzanne, so much for that warm introduction. And I see some familiar faces on the Zoom, so welcome everyone. I just wanted to thank you all for your time and being part of this Zoom. If you have any questions you'd like me to answer, please feel free to post them on the chat. I am more than happy to answer questions as they are posted. And I wanted to thank Suzanne for also emailing. There was a probate handout that I sent her kind of last minute, which I apologize for the last minute nature of that. But there is a handout on probate that has an attachment that shows how the probate fee is calculated in the state of California. So if you need that handout, please feel free to email myself or Suzanne. But basically our goal today is to provide an educational presentation about probate. There's a lot of misinformation about probate, so why don't we just go ahead and dive in and get started. And let me preface this presentation by saying everything that I'm speaking about today is California specific. It's important to understand that every state in the United States has their own approach to estate planning. And ironically, the East Coast used to make fun of the West Coast because of our use of trusts. And now, several years later, it seems like pretty much every state in the United States utilizes trusts. And to our credit, the West Coast was really the first that started using and utilizing trust. So just wanted to mention that. Sometimes people will ask me questions about a loved one that might live in Texas or Virginia or a state outside of California. And because I'm licensed in the state of California, I don't know other states' laws. And legally, as a licensed attorney in the state of California, I can't give advice about other states' laws. So if any of you have loved ones that live outside of the state of California, if you have any questions about the legal process in that state, you would want to consult an attorney that's licensed in that state where a loved one is living to get advice as to how that state approaches this topic. So in the state of California, what happens is if I died yesterday, to not jinx anything, the question becomes, does my estate have to go through a court process called probate? So what probate is a court supervised process when a person dies where the courts are involved with the administration of a decedent's estate. And the purpose of probate is the state of California wants to ensure when a person dies, one, that all of their beneficiaries are properly notified that a person has died. So if anybody wants to contest the estate or put a claim against the estate, they can. The other purpose of probate, which is part of why it's a public process, is creditors audit the files in all of the probates in all the different counties. So if they're owed any monies, creditors will claim against the estate. And then three, the other purpose of probate is for a judge to supervise the executor or the administrator to make sure that a decedent's final debts, bills, and taxes are all paid in full, because legally you cannot inherit in the state of California until a decedent's debts, taxes, creditors, and bills have all been paid in full. And then finally, the final purpose of probate is to make sure that the administrator or executor has done what's called an accounting to the court, which I'll talk more about all this in some detail as we go through the presentation. And then the judge will approve final distribution, at which time the assets are distributed to the beneficiaries of the estate. So what happens in California is the question becomes, when does an estate go through probate? And the answer to that question is there's two items that take an estate through probate. One item is when a person dies, if they own real property that's titled in their individual name, that real property will trigger probate. And that's because California takes the point of view that each piece of real property is unique, and there's only one house like your house. So for that reason, the state of California requires that any real property that's not titled in a trust when a person dies has to go through this court process. The other thing that takes us through probate is if a person dies and if they have assets titled in their individual name that do not have a surviving beneficiary attached to that asset, if you added all of those types of assets together and if their total aggregate value exceeded $166,250, then that also takes us through probate. And an example of that would be if I died and if I had a checking account that had, let's say, $180,000 in it, and if I didn't have a beneficiary named on that account, so if I died with an account that's titled in my individual name that doesn't have a beneficiary named, then because the value of that account is over the $166,250, that account would also trigger probate. So there's three problems with probate. The first problem with probate is it is a public process. So anybody can pull your file and see who's inheriting from your estate, where your beneficiaries are living, your beneficiaries' dates of birth, social security numbers is all part of that public process. So if my husband and I died, and if our two children were inheriting from our estate, any stranger could pull our file and find out where our minor children are living, our children's dates of birth, their current address, and their social security number, which sadly in today's society, that's pretty much a recipe to steal somebody's identity pretty easily. So one of the biggest problems with probate is the lack of privacy because it is a public process and there's no way of avoiding that. So that's one downside to probate. The other downside to probate is the length and time that a probate has to remain open in the state of California before it can be closed. So under California state law, when a probate is initiated and once that first hearing has occurred and the judge has recognized an administrator or an executor to be in charge of administering the estate, from that date forward under California law, that probate has to remain open for a minimum of 6 months. So for a 6-month period, all of the assets that are part of the probate are under the jurisdiction of the court. So the only way you can deal with those assets is with the court's approval and involvement. And again, you have no privacy regarding any of that. So everything that's filed with the court is public information. So even though the state of California has a minimum of 6 months for the probate to be open, on average, most probates that our firm has handled are typically open from anywhere from 8 months to 1.5 to 2 years. And part of that is because in San Diego County, as large of a county as we live in, we have 3 sitting probate judges for our entire county. And unfortunately, with COVID and with the current status of affairs with the pandemic, because the courts were closed for a period of time, it just took our courts' compacted calendars and made them even more compacted. So if you filed a probate today, my guess is it could take as long as 1.5 to 2 years for that probate to be resolved. The other downside to probate are the fees. And this is important because this is something that's predetermined by law. So for example, when you call an attorney and ask them about how much they charge for an estate plan, that is a transactional transaction. So an attorney can decide how much money they're going to charge. But when an asset triggers this probate process, those fees are statutory, which is a fancy way of saying that those fees are predetermined by law. And it's a percentage-based calculation based on the gross value of assets before the probate court. So when I first started the presentation, there's 2 things that take us through probate. One is real property that's not titled in a trust. The other one is if you have assets that don't have living beneficiaries attached to them whose total aggregate value exceeds $166,250. So on the handout that I sent, or Suzanne's office was kind enough to send on my behalf, there is the probate calculation included in this handout. It is on page 2, I believe. It's on page 3. It's on page 3 of the handout. So I'm going to just real quickly talk you through the actual calculation, and then I'm going to give you an example about what this looks like in real numbers. So under California law, if my husband and I died, and let's say that our house was worth $900,000 and it wasn't titled in a trust, then our house will trigger probate. The fee of that probate is based on the gross value of the asset, which is $900,000. So the way the fee is calculated under this formula is the executor or administrator is entitled to 4% of the first $100,000 plus 3% of the next $100,000 plus 2% of the next $800,000 plus 1% of the next $9 million plus 0.5% of the excess over $15 million. And if you scroll to the very last page of the handout, I provided some examples just to kind of show you in real life what that calculation looks like. So I had an example that if a person died, and let's say that they had no estate plan in place, and if their house was worth $639,000, they had a bank account with $12,000, they had a life insurance policy of $500,000, an investment account with $220,000 for a total net worth of $1.371 million. The probate fee on that estate would be $43,095. And the reason why that probate fee is so high is because it gets paid twice. So most people need to hire an estate planning attorney to assist them with the probate process because it is a legal process that requires pleadings to be filed. It requires hearings to be attended. And usually it's best to have an attorney do all that since they know how to draft the pleadings, file the pleadings, and make those court appearances. So legally, the attorney is entitled to that statutory fee. And then if a person has a will, there's a person called an executor that is the person who's in charge of administering the will. They're also entitled to that statutory fee. So in this hypothetical, if a person died without an estate plan whose net worth was $1.37 million, $21,000 gets paid to the attorney, $21,000 gets paid to the executor, plus you have some publication fees and costs that are usually around $2,500 to $3,500 on top of that. So when a person dies and they don't have a will, then you have a person who's called an administrator. So for this presentation, when I talk about an executor is the person who's in charge of the probate when there is a will. An administrator is a person who's in charge of administering an estate when there's not a will. So what happens in California is when you create a trust, which I'm sure most everybody has heard of trusts, the benefit of creating a trust is you want to think of a trust metaphorically like a bucket. So once you put a trust in place, that's step one. The second step of the estate planning process is changing title of your assets and moving those assets into the bucket. Because in the state of California, if my husband and I died, and if we had a trust and if our house was titled in our trust, then our house would not have to go through probate. But if my husband and I died, and if we had an investment account that was titled jointly in both of our names, but didn't name the trust or any surviving beneficiary as a pay on death beneficiary, and if that asset was worth, let's say, $300,000, then that asset would trigger a probate. But it's important to mention in that last hypothetical, when you have assets that are titled in trust, or when you have assets that name the trust as a pay on death beneficiary, those assets are not brought into the probate process. They're excluded and they're protected. Only the assets that are titled in your individual name that don't have beneficiaries living attached to them, only those assets are part of the probate process. So I've had situations where people people have done an estate plan, they created a trust, their attorney put their house into their trust, and then later they refinanced their house, and unbeknownst to them during the refinance process, the house came out of the trust. Well, if a person passed away with ownership of a house that's not titled in a trust, that house will still trigger probate. So one common misconception amongst people in California is people assume that when they have a trust in place, there's no possibility of probate. And that's not factually correct, because what determines whether or not you have to go through probate is how the assets are titled at the date of your death. So when I first became an estate planning attorney, I remember talking to my dad about my grandfather's estate plan, and I asked my dad, because my grandfather lived in California, whether he had his affairs in order, and my dad said yes, he had gone to an attorney, he paid a small fortune for this attorney in Riverside to do this very complicated estate plan, but everything was in order. And I remember I checked the deed to my grandfather's house because I wanted to make sure that his house in Sun City was titled in his trust. And to my surprise, the house was not titled in my grandfather's trust. It was still titled in my grandfather's name. So I called my dad because I didn't feel it was my business. And I said, hey, Dad, you might want to talk to your dad, because even though he's got a trust, his house isn't titled in trust. So even when a person has a trust, you can still have a probate process when assets aren't properly titled. And oftentimes what happens is most estate planning attorneys will prepare deeds and put your property into your trust. But there are a handful of firms that I've encountered in the state of California, this one in Sun City, or Riverside rather, and there's a few that I've encountered here in San Diego, that the attorney will charge to do an estate plan, but what they don't offer in services is they don't offer to do a deed that transfers the house into the trust. So if you have a trust and if your house is not titled in your trust when you die, that asset will trigger probate. And based on that calculation that we just talked about, real property is the one thing that you don't want to go through probate, because those probate fees are always going to be at least $7,000 to $14,000 and higher. We've had probates that were as high as $150,000 in statutory fees, because we had a client who wasn't our client at the time, but she had securities worth a couple $1 million, none of which were titled in trust, and none of those securities named her kids as her beneficiaries. So when she died, even though she had a house that was in a trust and she had her bank accounts in her trust, because she had these securities that weren't in trust and that didn't have any beneficiaries attached to them, those securities did have to go through probate. And unfortunately, because the value of those securities were so high, the total probate fee was $150,000, which is a lot of money. So when you hear of loved ones that have trusts, it's not because they're special. It's not because they're any more important than the rest of us. It's usually because they are homeowners that want their house to not trigger probate, but to avoid probate, or they want to make sure that their assets are in trust, so that also avoids probate. But being that you're all UCSD employees, faculty, and staff retirees, one thing that's important to note while I'm talking about all this is your retirement accounts, your 403Bs, your IRAs, your simples, your 401Ks. Those assets are under federal law, so they are the one exception to everything I'm talking about. When it comes to tax deferred assets, any kind of a retirement asset, which also includes annuities, you don't want a trust as a beneficiary on those types of assets for tax reasons. You always want to name individuals. And whenever possible on a retirement or annuity account, you always want to have a primary beneficiary and a secondary beneficiary. The benefit of having two beneficiaries listed is if, heaven forbid, your primary beneficiary predeceased you, it's always prudent to have a secondary beneficiary in place, because as I mentioned earlier, when a person dies, if they have assets that do not have a surviving pay on death beneficiary attached to them, if all of those types of assets added together exceeded $166,250, then those assets do trigger probate. So I have had people call and say, Heidi, I don't own a house. Do I need a trust? And then the question is, what's your net worth, excluding the value of retirement assets? And then I ask them if they have beneficiaries that they want to inherit that are younger, because one other benefit of having assets in trust is you can put age contingencies in a trust. But whenever you go through probate, under the laws of the state of California, if you have a minor, then that minor's inheritance will be under the jurisdiction of the probate court. And once each minor that was a minor at the time of the decedent's death turns age 18, that is when the state of California will give the minor whatever monies remain in their probate account, and that's when they legally are entitled to inherit it. So one other downside to probate is if you have younger beneficiaries, once they turn age 18, they inherit everything. But when you have a trust, you can put age contingencies in place with a trust, so you could defer those distributions until a later date. Maybe you give a little bit of monies when beneficiaries turn 25 or graduate college, whichever occurs first. Maybe you give another distribution when the beneficiary turns 30, when they're getting married, starting a family, buying a house, and maybe you give the final distribution at age 35. So another pro and con of probate versus not having probate is whenever your estate goes through probate, you don't have any control or discretion as to how assets transition from you to your beneficiaries. Once each beneficiary turns 18, they automatically get a distribution. So let's talk about how the probate process works. So when we file a petition to open a probate, what generally happens is when we file that petition, it usually takes anywhere from 2 to 3 months until we're given a hearing date. When you have an estate planning attorney, only the attorney is legally required to appear at that first hearing. So the executor or administrator does not have to be present in court unless they want to be. And that first hearing is really to have the judge appoint a person to be an executor or to be an administrator. So usually I find that that first hearing, I might have to wait for an hour or 2 hours until it's my turn to make an appearance. But once I'm called, I usually have about 30 seconds to 2 minutes in front of the judge, because it's a super quick and easy hearing. The reason the hearing is super quick and easy is because the majority of the legwork is all included in the document called a petition. And the purpose of the petition is that is the document you file with the court, letting the court know whether or not a person had a will or did not. If a person has a will, the benefit of having a will is the will identify who the decedent wants to be the executor. The executor is the person who's under a fiduciary duty to administer the estate, which means once the judge recognizes and appoints the executor with the letters from the court that are called letters testamentary, the executor will use those letters to pay the decedent's bills, to have access to their accounts. And that is the executor's primary role and function, is to pay all the debts of the decedent. Once the other thing that the petition will include is it will identify who the beneficiaries are in the will, because legally the beneficiaries are entitled to be notified that this court process is about to occur. The other side of that is when you notify the beneficiaries that this court process is about to occur, it also opens a statute of limitations if any beneficiary wants to contest the will or to contest the estate. I will say that by far and large, most people don't contest estates in the state of California. A lot of that, what you see in movies and TV, is highly dramatized, because in the state of California, nobody is legally entitled to inherit from your estate. So when a person does bring a contest to contest an estate, the burden of proof is on them to show why they would be entitled to inherit, which legally nobody's entitled. So that burden of proof is a lot harder to meet than people realize. So when the petition is filed, it's also going to identify the assets that are included in the probate. So really the purpose of the petition is to show a judge at a glance whether or not there's a will. If there's not a will, then California has a law called an intestate statute. Basically, the intestate statute is like a will when you don't have a will. So if I died and if I didn't have a will or a trust, the state of California is going to look to the intestate statute to see who the rightful heirs and beneficiaries of my estate would be. So if I died as a married person, the state of California will give all of my community property automatically to my spouse. But if I have any separate property is divisible in a fractionary share between my spouse and children. So if I died without a will or a trust, and if I have community property and a surviving spouse, my surviving spouse gets all of those assets. And if I have separate property, which would be assets that I owned prior to marriage, or assets that I inherited or were gifted during marriage, or if I have a prenuptial agreement identifying any other separate property, then those assets are divided based on how many children I have. So if I have one living child, my separate property would be given 50% to that one surviving child and 50% to my surviving spouse. And if I have more than one child, then the separate property is divided 1/3 to my surviving spouse and 1/3 to my children, regardless if there's 2 children or 5 children. If I don't have a surviving spouse, then the intestate statute is going to give all of my assets to my legally adopted or biological children. So if I have 2 biological children, they would inherit from my estate 50-50. If one of my children predeceased me but had children of their own, so I have a deceased child with grandchildren surviving my deceased child, we would still divide my estate 50-50, with my surviving child getting their half of the estate, and my deceased child's children would get the deceased child's 50% of the estate. I want to note real quickly, and I saw that there's a question in the chat that I'll get to in just a second. I'll bring this up in a minute. If I pass away as a single person, no surviving children, grandchildren, or great-grandchildren, then the intestate statute would give all of my assets to my grandparents, or to my parents, or to my surviving parents. If both of my parents have passed, then my estate would go equally to my siblings. If any of my siblings have passed, then their share would go on to their children, my nieces and nephews, then great nieces and great nephews. And if there are no surviving siblings, nieces, nephews, great nieces, or nephews, then we go to grandparents or surviving grandparent. Then we go to aunts and uncles, first cousins, second cousins. So one thing I just wanted to mention real quickly before I go to the question in the chat is, in the state of California, if I do not have a will or a trust, and if I am a blended marriage, California does not include stepchildren in that intestate statute distribution scheme. So if my husband hypothetically had 2 children from his first marriage, and if I had 2 children from my first marriage, and let's say, to make the numbers easy, we had 2 children together for a total of 6 children. If I died without a will or a trust, the intestate statute is going to give all of my community property to my spouse, giving him 100% of our assets. And then when he dies, if he does not have a will or a trust, under the intestate statute, the state of California is going to give all of our assets to his biological children, which is 4 out of the 6. So just know, in a blended family situation, it's really important for you to have a will to acknowledge your spouse's stepchildren, so that if it's your intention that all the children inherit equally, including stepchildren, you have to include them by name in a will, because otherwise the intestate statute would automatically disinherit those stepchildren. Okay, I'm going to go to the chat here real quickly because there's a question. It says, if I were to set up inheritance in a trust to grandkids as they age, who would administer it over the next decade or so? Are there third parties, banks, who administer this? Is it costly? So that's a great question. So when you create a trust, you do get to pick a person who's called a successor trustee. Ideally, in a trust, you want to nominate at least 3 successor trustees: first choice, second choice, third choice. It is important to note that you are nominating these individuals. So if the first person you nominated is not able or willing to be your trustee, that's when it's good that you have a second person listed. There's also the flexibility of resignation built into these documents. So if at any time, if your successor trustee needed to step down or resign, they can. And then you can have a trustee can be a family member, it can be a close friend, it can be a corporate trustee, or it can be a private fiduciary. I personally am of the opinion that when you have family and friends that can do this role, I think that's ideal, because these documents do have language in them that enable your family member or friend to retain legal counsel to help them through this process, because nobody expects a trustee to know how to administer an estate. Just like in a probate, there's also a statutory fee that's paid to the executor or administrator for their time and trouble in administering the estate, which is part of why probate's so expensive. So estate planning always will give a compensation to the person who is in the administration role. As far as whether it's better to have a personal friend, family member, corporate trustee, or private fiduciary, my first choice is always family and friends, because they can hire and fire professionals to help them through the process. My second choice would be a private fiduciary, because most private fiduciaries are willing to roll up their sleeves and get their hands dirty and make difficult decisions. Whereas a corporate trustee would be my third choice, because I find that oftentimes with corporate trustees, they don't want to exercise a lot of discretion because that's in the gray area. And anytime you make legal decisions in the gray area, you do open yourself up to be potentially sued. So corporate trustees are my least favorite if your estate is giving monies to younger beneficiaries like grandchildren, because part of the whole purpose of the trustee is to make decisions about when to make distributions to a beneficiary and how much money to give. So there is a lot of discretion that's automatic in a trust. So personally, I find that corporate trustees, can you turn your camera back on? Oh, I didn't know my camera was off. Oh, okay, there we go. Sorry. So when I talk about the intestate statute, basically that's a statute that's going to find your closest living blood relative. So in California, if you have a will, the benefit of a will is you identify who the executor is. That's the person who is in charge of administering your estate. And you also get to identify beneficiaries. When you don't have a will, then the intestate statute applies, where the state of California decides who your beneficiaries are. And when you don't have a will, you don't have any control or say as to who will petition the court to be put in charge of administering your estate. So obviously one benefit of having a will versus not is, I think each of us probably know within our family and friends who are our first, second, and third choice people to be in charge of administering our estate, because that's a really important role. I do have a question about, there's an individual whose house, their house is titled in trust, but the deed has the trust misspelled. Is that important? I think yes, because you don't ever want to take a possibility of going through probate. If you have a deed that has a misspelling in it, there is another deed that can be recorded called a correction deed that can fix that misspelling. I would fix it. You don't ever want to have any doubts about how real property is titled, because you never want real property to have to go through probate. So when you file that petition to open a probate, the very first hearing, as I mentioned earlier, the purpose of that first hearing is to get a person appointed. Once the court appoints the individual to be in charge of administering a decedent's estate, the court then issues something called letters testamentary. Letters testamentary are the letters from the court that the executor or administrator uses to show the banks to deal with the assets that are titled in the decedent's name. That's how the person in charge of the estate gets their name added to title, so that they have management and control over these assets during the probate process. One of the most important things for a person to do once they are recognized by the court and they are the executor or administrators, they want to protect the assets. So sometimes I'll encourage an executor to change the locks on a house, because you don't always know who has keys to the house. That is one of the roles of an executor, is to protect and to marshal these assets. The other thing I tell an executor is, if you have a car or a vehicle, whether it be a motorcycle or an RV or a mobile home, nobody should be driving any vehicles titled in a decedent's name, because if a person were, so if I died, and if my executor was driving my car, and if they caused an accident, now you're going to have a creditor claiming against my estate. So when a person passes away and there's any type of a vehicle, whether it's a motorcycle, an RV, a car, what have you, my rule of thumb is to not let anybody drive those vehicles until that vehicle has been sold, donated, or the title has been changed into the beneficiary's name. While a vehicle is not being driven, you still want to start the engine occasionally, because you don't want the oil to get, I don't know the technical terms, but I do know that you need to continue to start the car's engine every so often. You can put the car on non-operating status, which I believe the insurance cost goes down pretty significantly, because if you're not driving the car, it doesn't have to be fully insured. It can be changed to non-operating status. But usually I always want the executor to deal with the vehicles first, because they are a potential liability against the estate. So once we've either sold, donated, or gifted the car, the next thing that you need to deal with is all the stuff that a person owns. So when a person has a will, they can identify in the will who gets their household belongings, the couch, the TV, the jewelry. Oftentimes I find that people don't take the time to specify, which is fine. They want their loved ones to come into their house and pick and choose between them who wants the couch and the TV. That to me is one of the most difficult things for an executor or a trustee to be in charge of, because oftentimes, with all due respect, when most of us die, we die with a lot of stuff. So what I generally encourage an executor to do is to give everybody a legal pad, have them walk around the house and just make notes as to what things they want. Legally, these items of tangible personal property don't have to be distributed penny for penny. So that is where you really just want to have everybody just pick and choose the things that are important to them. If there are things of value, the executor can retain an estate appraiser and have an estate sale. Or the executor could donate the remaining items to a charity or to a tax exempt organization. But I will say that dealing with the distribution of the tangible personal property takes a lot of time. If any of you have items that you already know you want to give to loved ones, it's always a great idea, if you're no longer sentimentally attached to the item, just to give those items away while you're alive, because that way you have the benefit of seeing a loved one enjoy that item. If there's something that you think people might fight over, then like a wedding ring, because there's only one wedding ring, then it is a good idea to make a handwritten will as to who gets the wedding ring, the couch, the watch, things that you think people might fight over. Can you please comment about life insurance concerns? So when you have life insurance, you want to have, so if you have a trust and if you have a life insurance policy, you would name the trust as the beneficiary, because you'd want that life insurance money to go into a trust account so the trustee has the benefit of using that life insurance money to pay off a mortgage if there's a mortgage due on your house, or to pay your final bills. If you don't have a trust and if you have life insurance, then just like with the retirement accounts, you want to make sure you have a primary beneficiary and a secondary. As long as life insurance has a living beneficiary or a trust identified as a beneficiary, then that money will not trigger probate. Okay, so going back to the probate process. So we filed the petition. The executor has notified the beneficiaries that the probate is starting. Generally, as I mentioned earlier, most people don't contest an estate because there is language in a will that if a person contests an estate and if they lose, then they forfeit their right to inherit. So another benefit of having a will versus not having a will is there is this no contest clause that is pretty standard in the state of California. So if I have an estate that says 50-50 to my two kids, I'm sorry, if I have a will that says 50-50 to my two kids, and if one of my kids says, you know, mom really gave you more money than she gave me, I should get more money from the estate. If that child actually lawyered up and went into court and said, Your Honor, this will says 50-50, but it should really be 80-20. And if the judge disagrees with that child and they lose that claim, then they forfeit their right to inherit. So another benefit of having a will versus not having a will is having these no contest clauses, which really keeps people on the up and up, and it keeps them from litigating, because if they do try to litigate and if they lose, then they forfeit their right to inherit, which is a pretty big deal. So once the probate has started, the statute of limitations for a beneficiary to contest is 90 days. It's a pretty quick statute. Once the statutory period to contest is passed, then the executor is in the due diligence period of paying all the decedent's final bills. Because as I mentioned earlier, nobody can inherit from an estate until all the bills are paid. So one of the things the executor has to do is they have to go through all the important papers. They have to go through all the boxes in the garage. They have to go through all the files. They have to go through the mail. Honestly, one of the most important things that you could do for your loved ones is make a list of all of your assets and debts, so that if you did become incapacitated or pass away, giving your loved one a roadmap as to what your assets and debts look like, what your bill pay schedule looks like, when do you pay your mortgage, how do you pay your mortgage, do you pay it online? If so, what's your password, how much do you pay? Is the property taxes included with the mortgage payment? If you felt comfortable putting all of that into a written document, whether you type it and it's a computer file or you handwrite it, that is one of the most important things that you could leave to your loved ones, because trying to figure out a person's assets and debts is very difficult for most of us, because oftentimes that stuff is all over a person's house, which just slows down the process, which is part of why a probate does have to be open for a minimum of 6 months, because it does take time to figure out what debts a person has. The other thing I encourage the executor to do is to notify the reporting agencies, TRW. Oftentimes, sadly, a person's identity is stolen when they die, and part of that is because these probate processes are public, so it's very easy to find that a person has died, their last address, their date of birth, social security number. All of that critical important information is included in that public process. So anybody who pulls the file will have access to all that information regarding the decedent. So sadly, it's not uncommon for a person's identity to be stolen after they pass. So if you contact the local credit bureaus and credit reporting agencies, letting them know that a person has died, they can flag that person's social security number and try to prevent any unnecessary credit card fraud or identity fraud. And then once you get to the point where the executor has done their due diligence, they've paid the bills, they've paid the debts, then you get to the almost end of the probate process. And one of the most important things that an executor has to do, which a trustee also has to do in administering a trust, is they prepare a document called an accounting. And the purpose of the accounting in a probate is for the executor or the administrator to show transparency to the court as to what the financial history of the estate has been from the day they were appointed to that date and time. And really what you're doing is you're showing the court, here's the assets that the decedent owned, here's the debts that the decedent had, here's proof that the decedent's debts have all been paid. If any asset has been sold, for example, if a car was sold or if a car was donated, that would be included on the accounting. If the executor or administrator has an attorney, the attorney's fees would be included on the accounting because that's an expense of the estate. The executor and administrator fees would also be included on the accounting because that is also an expense of the estate. And then basically the final point of the accounting is to show the judge what the net estimated value of the estate is, so that the judge has an idea as to how much money each of these beneficiaries will ultimately inherit. So it's also important to note that if you had 3 beneficiaries, and I'm going to make the math simple and say that there was $300,000, it's not as though each beneficiary has to inherit a third of each individual asset. If you have a net estate worth $300,000, what matters is that each beneficiary gets $100,000 worth of assets from the estate. So if one beneficiary said to the executor, I want my $100,000 to all be Apple stock, then the executor can put the Apple stock in that beneficiary's name and give the other 2 beneficiaries other assets. So sometimes people will ask me, if there's a house and if there's 3 kids, how do you decide who gets the house? And the answer to that is that decision gets answered between the executor and the children. So one really important thing to understand about an executor is they are the decision maker. So if you have 3 kids that all want to co-own a house, the executor can issue a deed putting title of that house into all 3 beneficiaries' names. Or what I've seen happen is maybe one of the 3 kids wants the house as part of their 1/3 share of the estate. But sometimes you have estates that are real property rich and cash poor. So now you have a beneficiary who is inheriting more than their 1/3. So now they have to come up with some kind of a promissory note, or they need to find a way to pay the other 2 siblings for the excess value that exceeds their 1/3 of the estate. And all of that is easy to deal with, but one really important thing to understand is when you have a trustee in a trust or an executor or administrator under a will, they are the decision makers. So if a beneficiary approached an executor and said, I want the house, but if the executor would prefer to sell the house, the executor has the right to make that decision. So in picking an executor or a trustee, you want to pick somebody who's business-minded. You want to pick somebody who's going to treat your beneficiaries impartially and fairly and equally. You're going to want to pick somebody who is a good communicator. You're going to want to pick somebody who's proactive. You don't want a trustee or executor who's going to just kind of sit back and let a whole lot of time go by and not be on top of doing this role. Because one nice thing about probate is when you are before the court doesn't give you the benefit of sitting back and grieving, because it is a job. And when you agree to be a trustee or an executor, it is the job that you don't have to do. So you don't have the benefit of telling a judge, oh, Your Honor, I'm grieving, I need more time. A judge will never accept that as a viable reason if things are taking too long or if they're delayed unnecessarily. So when you do agree to do this job, you are acting in a fiduciary capacity. which is one of the highest legal duties imposed by law. So you have to make sure that you know what you're doing and how you're doing it. And then once the trustee or executor, once the executor has submitted the accounting to the probate judge, the judge there is a final hearing. And that is the judge's opportunity to ask the attorney, who's usually appearing on behalf of the executor or administrator, any questions that they might have about assets, expenses. And then once that accounting is approved, there's also a petition to close the estate that's filed with the accounting. And once the executor has shown the probate judge through the accounting that all the debts have been paid, all the final state and federal income taxes have been paid, and that there's no outstanding debts, once that accounting is approved, then the judge can approve the petition to close the probate. Once the petition is approved to close the probate, that is when the executor or administrator will then change the title of the assets into the beneficiaries' names. And once these assets go into the beneficiaries' names, then the probate is automatically closed. And then the attorney can file a discharge with the court to have the executor discharged. Should or must a person be asked before being named on an? Okay, so another question that was just posted is, should you ask a person whether or not they're willing to be an executor in the will before naming them? And the answer to that question is that is totally up to you. One nice thing about an estate plan is it is amendable, which is a fancy way of saying it's changeable. When you do an estate plan, you want to think of your estate plan like a car. Once you buy the car, it's probably going to be good for about 6 to 10 years, but then it will need some tune-ups along the way. So when you create an estate plan and when you make the decisions about executors and beneficiaries, you really want to make those decisions with a mindset that what if something happens to you in the next 10 years? Because the tax laws do change both at the state and federal level. So as a general rule of thumb, you do want to update these documents about every 6 to 10 years to bring them current to current laws, because you can have outdated language in these documents, which isn't always ideal. So when it comes to naming an executor, you can ask a person if they're able and willing to act, and you might want to friendly remind them that you are just putting your legal affairs in order and you hope this is something that they won't have to do for a very long time. You can also friendly remind them, if you're having that conversation with them, that they are just being nominated in these documents. So if at any time they want to reject the nomination, they don't have to act in any capacity if they choose to decline that nomination, or if they accept the nomination, but later down the line, life happens and they need to step down, there is the flexibility of resignation built into all of these documents. So I do think it's important, if you want to have this conversation, just to friendly remind your loved ones that you are just getting your affairs in order. You hope they won't have to do this for a very long time, but if they do have the flexibility of accepting or declining the nomination. And at any time during this process, if they need to step down and resign, they can. As far as executors go, if a home is being sold through probate, is that process done before the final hearing? Okay, so that's a good question. So I will say that when you have assets before the probate court, once the executor or administrator has been recognized by the judge, then you do have full power and authority over the assets before the probate court. So if there is a house, and if you do want to sell it while the probate is ongoing, there is something called a notice of proposed action that you want to give to all the beneficiaries. And the purpose of the notice of proposed action is to, one, to let the beneficiaries know that you intend on selling the property in case if any of them want to buy it. Two, you also want to let the beneficiaries know what you're listing the house for, so that they're all in the know as to how much money you're going to list the house for sale for, the price. And then three, if you have any kind of a relationship with the realtor, you also have to disclose that to avoid any conflicts of interest. So when you have real property and when a probate is ongoing, you do have the ability as the executor during the course of the probate to sell the asset. And then when you do the accounting, if you change the form of an asset, so if you had real property, but you sold it, and now that that money is in a probate account, you'll identify that that asset has been sold and the monies is now in the probate account, so that the court knows that the form of the asset has been sold. But if you do sell an asset during a probate, the net sale proceeds from that asset has to stay in a probate account because it is under the jurisdiction of the probate court. So those monies can change form, but that asset has to be put into a probate account because it is part of the court's jurisdiction, and those assets can't be distributed until that final petition has been granted and approved by the judge. So I have had situations where an executor has decided to sell a house during the probate, which is fine. I have had other situations where the beneficiaries weren't sure if they wanted to keep an asset or not, so they held on to it. And then after the probate was closed, the asset went into the beneficiaries' names, and then collectively they decided to sell the asset, which is also fine. So that's a decision that can be made between the executor and the beneficiaries when the time comes. There really is no right or wrong answer. And I think that is all the questions. Let me just check the chat one more time. I'm pretty sure I got everything. Let's see. Okay, there's a long question here. Can you like it? Okay, I have another thing I'm going to talk about. Okay, I think I got everybody's questions. So one thing I do want to talk about, because there was a question in the chat about a life insurance policy. When you have life insurance, retirement assets, taxable investment accounts, tax deferred investment accounts, a common question people ask me is about taxes. So one thing that's really important to know in the state of California is if you hold assets, it's really better for your beneficiaries to inherit those assets after you die versus to be gifted those assets while you're alive. And the reason is if I bought a house, in fact, I had a client retired from UCSD who built a house overlooking the ocean there in La Jolla, beautiful house. They paid $40,000 for the lot. And then unfortunately, one spouse was really sick. The house at that point in time was worth over $4 million, and they were going to sell the house. And because I knew that the one spouse was terminally ill, I said, with all due respect, you might want to wait on selling that house, because if one spouse dies and then the house is sold, all that capital gain is forgiven. Whereas had they sold the house while both spouses were living, they would have realized a capital gain between $40,000 and I think the house was worth like $4.2 million, which is a very significant capital gain. So in the state of California, when you have two spouses, when one spouse dies, when the first spouse dies, all the capital gain and appreciation is fully forgiven. So what I see happen a lot is between a married couple is when the first spouse dies, probably within a couple of months to a year to 2 years, the surviving spouse might want to sell that house and downsize because maybe they don't want as big of a house, or maybe they don't want to be in a 2-story house. So if you have a highly appreciated asset like real property, if you hold on to that until the first spouse dies, then the second spouse, if they later sell that house, will not pay any capital gain. The same thing applies when you gift assets to your loved ones. So if my husband, if I die first and my husband inherits my share of the assets, he gets a forgiveness of capital gain in a stepped-up basis. And then at his death, our children get a second forgiveness of capital gain, and they get a stepped-up basis. So what you don't want to do is you don't want to add your adult child onto title of your property, because when you gift assets during your lifetime, there is no forgiveness of capital gains, and you have now a gift tax issue, because it used to be in 2021, you could gift a person $15,000 gift tax free. Fast forward to 2022, that went up $1,000. So now you can gift $16,000 per person in 2022. And then when you die, there's something called a federal estate tax, and that's the amount of money you can give lump sum tax-free. So last year, you could gift $11.4 million per person tax-free. So as a married couple, you had $22.8 million in your bucket. Fast forward to 2022, that went up to $12.6 million per person. So when you pass away and there's life insurance, whether it's $25,000 or $100,000 or $2 million, as long as your total net worth is under that year's unified tax exemption, there's no federal estate tax to be paid, which is a tax at a federal level that occurs when you die. One nice thing about, well, there's a lot of nice things about California, but California is one of the few states that does not impose a state estate tax. So in some southern states, when you die, you have to pay taxes just because you died. But in the state of California, when you die, there is no estate state tax to be paid here. The only thing that your beneficiaries might have to pay taxes on are any taxes that you deferred while you were living. So if I inherit a retirement account that my husband was deferring taxes on, when I receive those distributions, any taxes he was deferring, I'll have to realize when I take those distributions. And then there was a question in the chat that said, what happens to social media accounts and probate in cloud storage? Yeah, that's a good question. So now in our estate plan, one of the new things that we're adding into trusts and wills and durable powers of attorney is language giving your trustee or executor access to your cloud, to your passwords, to your digital asset information. When you don't have a will or a trust, and when a person is appointed as an administrator, they do have power over those types of assets. So when you have an estate plan, those powers are automatically included. But when you don't have an estate plan, once a court appoints you, you're given those powers through that appointment. And again, it is helpful, just like leaving a list of your financial assets, it is important to have a list somewhere of your digital assets, your logins, your passwords, social media, computer, whatever those accounts might be, because part of your executor or trustee's job is to close all of those accounts down. Okay, so what is the difference between executor, limited authority, and full authority? Good question. So when you have an executor with limited authority, that means they're only given certain powers. When you have an executor who has full authority, they have full powers. So I've never administered an estate when a person had limited powers, because frankly, I don't know why you would limit those powers, because you want a person to have full authority and power over all assets that are part of an estate. But sometimes there's situations where you might have an executor who only has power over real property. But in all the probates we've handled, we've always had full authority, which means we've had power over all assets in the decedent's name that didn't have a beneficiary attached to them. Okay, well, that is pretty much the end of my presentation and the information that I wanted to present about probate. I'm happy to answer if there's any other questions that anybody wants to post in the chat, please feel free. If you have a question that you're not comfortable asking publicly, which I certainly understand because this is a pretty private topic, my name and email is on that handout. If you have any questions you want to email me privately, I'm more than happy to answer them. Otherwise, I'm going to click back to the chat and see if there's any more questions.
Just one question for you, Heidi, in regards to ARAG insurance and administration of estates. Can you address that, how that comes into play?
Yeah, so when you have ARAG insurance, which is a really great legal insurance plan to have, so for those of you who have it, use it. And for those of you who have it, basically, if you have full ARAG coverage, what that means is your estate plan is covered. When you have partial ARAG coverage, then you are out of pocket for a portion of your estate plan. So anytime we accept a client who has ARAG insurance, one of the things we ask our clients to do now is to call ARAG and to verify their coverage, because I do think it's important to know what your insurance covers and doesn't cover. But typically, most ARAG people that have full coverage, your trust, will, durable powers of attorney, and healthcare directives are going to be covered. What's not covered are notary fees, and the deed fee is not fully covered. If you have trust administration probate coverage, which I find probably 50% of people have and 50% of people don't have, what that does is it does pay around $750, which I think is about 8 hours of time. We haven't used ARAG for probate, so I'm not as familiar with how ARAG works for a probate matter, but we have used ARAG when a person dies for trust administration. But ARAG is a super great company to work with. They're super user-friendly. For those of you who have the insurance, I would encourage you to call ARAG if you have any questions about coverage. I know that estate planning is an offered benefit. Trust administration and probate is also an added benefit. But as I mentioned, I'd say probably 50% of my clients have the estate planning coverage, but not trust administration or probate coverage. So I would call and find out exactly what's covered. I assume you can upgrade your plan if you felt that appropriate. I'm not saying you need to, but again, just calling and getting the information is key.
Okay, are there any other questions from members?
One question is, can you please explain more about capital gain? Capital gain is basically a tax you pay on an asset that has appreciated. So if I bought a house for $600,000 and then 5 years later I was going to sell the house, but now the house is worth $1 million. In California, if you live in a house 5 out of, I think, I'm not sure if it's 2 or 3 out of the last 5 years before you sell it. If you're single, you get a $250,000 forgiveness of capital gain. If you're married, you get $500,000 forgiveness on capital gain. So in my hypothetical, if I bought a house for $600,000 and then I wanted to sell the house, it was worth $1 million, but I'm married at the time of sale. And as long as I lived in the house prior to selling it 2 out of the last 5 years, then I won't pay capital gains because I get the $500,000 forgiveness. But that capital gain is only realized when you sell assets while you're living, because when I die, if my husband and I bought a house for $600,000 and at the time of my death the house was worth $1 million, he gets a new capital gain basis, which means his new adjusted tax basis goes from $600,000 to $1 million. So if 3 years after my death my husband wanted to sell the house, and let's say the house was worth $1.2 million, he wouldn't pay capital gain because his new tax basis adjusted at the time of my death to $1 million. And as long as he lived in the house 2 out of the last 5 years before the house was sold, and because he is a single man gets a $250,000 capital gain exclusion, he wouldn't realize capital gain. So capital gains is a tax concept. My best advice to anybody is, if you're thinking about selling real property, talk to your CPA and have them do a tax analysis. Before you sell real property, you always want to find out what type of tax consequences are involved, and your CPA is the best person to give that analysis. And then the other question in the chat is, what does UCSD offer with ARAG? I don't really know how to answer that question. All I know is that if you are with UCSD, they have what's called open enrollment in November. It's not guaranteed. It's not every November, but ARAG is a benefit that you are offered that you can sign up for. And if you apply for it, it's basically legal insurance. If you have any questions about ARAG, you can call HR there at UCSD and find out more about ARAG. Is it partial coverage or full coverage? I don't know. I don't know if you have the option of doing one versus the other, if one's more expensive or less expensive. I'm not an insurance expert. All I know is that we accept that insurance. So as a courtesy to clients who have ARAG, we do accept the insurance, which means that your estate plan is going to cost less money. But as far as how the insurance works, I would call ARAG to figure that out. And how you get the insurance, I would call the HR there at ARAG to find that out.
Let me just pipe in and say it's really reasonably priced. There's one option. I think it runs somewhere around $10 or $11 a month. I mean, you hardly even see it or feel it. And it's just one option. And again, to get full information on it, you have to wait until open enrollment when they, if it's available, because again, it is not available every year.
Yeah, that makes sense.
Okay. All right. So it looks like you have answered all the questions. Man, that was so dense, so much great information. I really appreciate your mastery of the topic and your excellent presentation. Really, really appreciate it. anyone again with questions about ARAG, please address those questions to HR. Okay, so HR can answer those for you. But thank you so very much for being with us today, Heidi. And for anyone who wants to watch this again, it will be posted on our RA YouTube channel within the next day or so. Okay, have a great day. Thank you.
Thank you. Bye, everybody.
Bye-bye.